Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. We have a lot of things to cover today. We want to talk about our indicators. We want to spend a little time talking about Gilead and then finally about the markets and the outlook for the economy. So let's get started. Our first indicator is oil. And as you can see from this chart, the price of crude oil was at 104 recently, in the last 90 days or so. Reached a low of 90.42 and currently stands at 92.21. If we were going to have a significant economic recovery, I would expect to see the price of crude oil rise, not fall. Some analysts believe there is as much as a $10 to $15 a barrel fear premium or political risk premium in the price of crude oil. That would mean instead of 92, we would be looking in the neighborhood of 78 to $75 a barrel if the fear premium were to be taken away. Saudi Arabia, for example, needs $85 a barrel just to break even. So at $75 a barrel, should things calm down in the Middle East, we would see a significant decline in the price of crude oil, which would affect those economies in the Middle East. Our second indicator is the price of gold. As you can see from this chart, gold was as high as $12.97. In fact, it went over $1,300 an ounce. Hit a low of $1,185 an ounce and currently stands at $1,228. There are some analysts who are now predicting that gold could fall to $1,050 an ounce from this level. If that were to be true, then the pundits who are looking for $2,000 an ounce by the end of the year for gold and $50 an ounce for silver would have a long way to go. They'd have to almost double the price of gold. Gold is an indicator of inflation and uncertainty. If we truly have political uncertainty in the Middle East and we have concerns about inflation, gold should be much higher than it is today. So that is telling me that the political uncertainty is not enough to drive up the price of oil. And our last indicator is the yield on the 10-year Treasury. As you can see from this chart, the yield on the 10-year Treasury was 254, about as high. It got as low as 234, and now it stands at 261. So a spread of about 7 basis points over the last 90 days in the change in the yield of the 10. If we look around the industrialized nations of the world, what we find is now the U.S. has the highest yield on most of its Treasury debt from 10 years and on out. So what we have is the quantitative easing that's still going on in Europe, driving interest rates down. One of the offshoots of that is a significant decline in the euro and the British pound. So now we have a situation where the euro is under 130, approaching 129, and the British pound 160, or 161, approaching 160. This also tells me that with interest rates at this level, there is not a significant demand for credit, and so I don't see a lot of expansion, a concern in the yield on the 10-year Treasury. Remember that the government was spending billions and billions of dollars a month buying back mortgage-backed securities and Treasury securities. They've all intensively stopped that by reducing it slowly. And my guess is they're going to start bringing their inventory to the market to raise cash to pay down the government debt, at least from the Treasury standpoint. So I don't see any significant upward pressure on interest rates. All this tells me is that the economy is still slow, that the blip in the second quarter was in fact a reaction to the terrible winter we had in the first quarter, and I think the third quarter will be less and the fourth quarter will be less than the second. Told us that they're going to be on hold at least until sometime in 2015, although the recent jobs number was a disappointment to the Fed. They would like to have seen more. And the number of anticipated layoffs is rising, so we may see in the second half of the year an increase on the unemployment rate and a reduction in the number of new jobs created, which would show signs of a sluggish economy. I think that we are in a malaise that until we get a change in leadership, whether it comes in the midterm elections or we have to wait in 2016, I just don't see it happening. And I expect that our indicators will probably stay in the range that we're in. Gold could go to maybe 1,350, but it could go to 1,050. We may see oil at $104, $105, but we may also see it at 85. And I don't think treasuries are going to trade much between, say, 250 and 275. So very tight ranges on all of our indicators, no real upward pressure to drive them higher. Should we see a spike in interest rates, that would have more impact on the stock market than a spike in oil or gold prices. If the rate of interest approaches 3% on the 10-year Treasury, which would put it at a yield higher than the yield on the S&P 500, you may see some reallocation away from stocks into Treasuries. But I'm not convinced that it's going to get to 3% this year. I also think the Fed is probably going to be hold all the way through 2015 and well into 2016.
So now let's talk about Gilead. Each of you have received your statements by now, and you'll notice if you add back in the money that you've taken, you are at all-time highs. We've recovered all of the money prior to that was lost during 2008 and 9. We're back to pre-2008 highs. And when you add back in the distributions that many of you have taken from your accounts over that period of time, you will find that you are significantly above the return on the market since March of 2009. One of the factors in doing that has been Gilead. Some other stocks have turned around and started to move positively. But clearly Gilead is our biggest winner. Very controversial company. Stock is now trading between 102 and 110. When many thought it wouldn't get above 100 until after the first of the year. I think that the stock is going higher. It's going to go significantly higher as we add Japan and Europe and other nations around the world who will be distributing their hepatitis C drug into the marketplace. I'm thinking that the stock probably in this run will probably go to maybe 115, 120, and it's going to be mighty tempting given the extremely low cost basis that we have in the stock to consider the possibility of taking a profit. But I'm not good enough to pick if you sell it, what's the best time to get back in. I like the stock a great deal. It's the best performing stock in our portfolio. It continues to go higher. I can create a formula for you that shows that the stock should probably go within the next 3 to 5 years north of $230 a share. So that's almost 100% more than what it is right now. I know that it will go up and down, and because it's such a large percentage of our portfolio, not on cost basis but on market value, we'll see some increased volatility. But I think that the bias is going forward is up. People have been asking me at what point would you sell it, and I said I bought the stock because it fitted my formula of paying for a stock that its market price was at a discount on its growth rate to its price earnings. What does that mean? That means if the company is growing at 50% a year and its earnings are only 15%, then it's woefully undervalued, and that the stock price has not had a chance to catch up to the growth rate. The longer the growth rate that Gilead continues at above 50%, and I suspect that could be for another year or two, there will be pressure on the price of the stock. For example, right now the market is trading at about 18 times earnings. Gilead is trading at about 13 times on forward earnings. So at 18 to 20 times, you get a valuation of the stock north of 200. So I'm hanging in there. There'll be some fluctuation month to month, but longer term, I think we're going to be pleased with the position, and I like the way the other positions are performing. So watch out for the rest of their portfolio, because they're bringing new drugs in all the time that will help diversify away from that particular blockbuster drug they have in hepatitis C. So let's talk about the markets. I believe that the markets are churning at the moment. They're trying to figure out whether they want to go significantly higher or significantly lower. Some people are saying there could be as much as a 15 to a 50% decline in the stock prices. Others are saying, no, we're going up to 2,500 on the S&P. I think we're somewhere in that range. As far as we are concerned in our portfolio, we have the insurance of the puts on the S&P 500 that will give us some protection. So as I said to you before, I am looking for some kind of a correction. How big the magnitude will be will depend on a lot of events and things that happen in the country and around the world. If we had another terrorist attack in the United States, I think you could see a 40% decline. However, we are protected, not 100%, we're not 100% hedged, but we do have some protection on the downside. So if a correction comes, I would expect to see us have a lower decline in value than the markets, and I think our portfolio will do extremely well. So look for increased volatility, trying to set new highs in the S&P 500 and the Dow Jones and the NASDAQ, but people beginning to wonder whether or not this is sustainable. September historically is a bad month for the market, more often than not. The last few years has been a little better, but over average over the last 100 years, September is a difficult month. October can also be a difficult month. So if we can weather the September-October malaise that could be affecting the markets right now, I think we'll do very well finishing out the year. So as always, thanks for watching. Should you have questions, please feel free to give me a call. And if you have friends or relatives who are looking for a real money manager, not somebody who just picks mutual funds, please feel free to give me a call. This is Dan Perkins, and thanks for watching.